It has been an eventful week for markets. Global attention was on the Middle East, particularly crude markets, with oil rallying to 2014 highs. Although well flagged, this was spurred by President Trump withdrawing the US from the 2015 Iran nuclear deal, as well as supply concerns. At the same time, there have been positives, with President Trump scheduling a historic meeting with North Korean leader Kim Jong-un on the 12th of June in Singapore. Now, with all this focus offshore, it was also a particularly big week in local markets. Before we discuss Australia's budget, firstly, we saw March retail sales numbers, which were disappointing. March saw a flat retail trade result, with weakness in all sectors except basic food retailing, which rose 0.7%. Now, looking at Q1 as a whole, nominal retail sales posted a 0.6% rise, but adjusted for prices, retail volumes rose just 0.2%. Now, this points to downside risks to the wider consumer spending measures in the March quarter GDP update. However, this report was overshadowed by the release of the budget on Tuesday night. The headline highlights are that there is an improved budget position, with the government projecting a return to surplus in 2019-20, 1 year earlier than previous. The stronger economy has delivered a $7 billion boost to the budget this year, and personal tax relief and the reversal of the Medicare levy increase feature as key policy initiatives. On the revenue side, the government will be targeting the black economy and tobacco. All three major rating agencies affirmed their existing AAA ratings and outlooks, with the budget not really causing any market reaction. The Kiwi dollar has been the weakest G10 currency over the last week. We saw the first RBNZ meeting from new Governor Orr, and while keeping the cash rate unchanged as expected, he stated that the next move in rates could be up or down, which is certainly counter to the global move towards higher rates. This saw the Kiwi dollar hit year-to-date lows under 70 cents, and this also pushed the Aussie-Kiwi cross above 108 for the first time since February. In another dovish turn, it's worth mentioning the Bank of England, which also held rates unchanged. Now, tightening at this meeting was priced a near certainty in mid-April, so it is significant that the Bank of England is now back to a more neutral stance as the UK economy really stumbled to start 2018 and the complexities of Brexit mount. This has understandably weighed on the pound, which has fallen almost 6% since mid-April. For the week ahead, domestically we have a big calendar with RBA minutes on Tuesday, and Westpac consumer sentiment will be released on Wednesday and analysed for reaction to the government's budget. We also see the labour force data on Thursday. However, perhaps the most important release will be the Q1 wages data on Wednesday. Given the current subdued pace of wages and the RBA highlighting the importance of seeing renewed wages growth to help achieve their inflation target, wages is shaping up as the key data series to watch. We'll also be watching oil markets. The current upswing in crude prices will support headline inflation globally for some time, but it could be a long shot to expect a flow-on impact to sustained inflation and wages. That is likely to keep global central banks cautious, and the US Fed fairly lonely in its expected tightening path. This should continue to support the US dollar. If this trend continues, any Aussie dollar strength will run out of steam around 76 cents. We'll be back to talk to you next week.